Welcome to the Deep Dive, where we unpack the critical research and data to give you the strategic edge you need. Today, we're tackling a huge topic: strategic longevity, what's often called perennidae, and the framework that really determines if your business will survive for the long haul. We're talking, of course, about corporate governance.
And this is not about just, ticking compliance boxes. This is truly about survival. We're basing our deep dive on the Evermonte Institute's latest study. And the data, well, it's a bit of an alarm bell for any founder thinking about legacy.
How so? What's the headline number?
Get this. Only 36% of family businesses even make it to the third generation. And if you look specifically at Brazil, nearly half, 49.2% of companies don't have any formal succession plan at all.
Wow. So longevity isn't something that just happens, you have to build it.
You have to architect it. And that's what corporate governance is. It's the strategy for perennidae.
So that's our mission today. We're using the Board Trends Brazil study as our guide to really dissect what's happening with boards nationally, their makeup, their challenges, and give you that blueprint.
Right. And if you're a founder listening to this, you might be thinking, governance boards. That's for huge public companies.
That's a common thought, isn't it?
It is, but that's exactly where the idea of advisory boards or Concilius consultivos becomes so incredibly powerful.
Okay, so break that down. What makes an advisory board so essential for a growing company, and how is it different from, say, a full administrative board?
It all comes down to power and control. An administrative board, the Concilio de Administración, has the final say. It has maximum decision-making power.
The buck stops there.
Exactly. But a consultative board is different. It's a hand-picked group of outside experts. They bring in that high-level specialized advice, but, and this is the key, without deliberative power.
That's a huge distinction for a founder. A massive one.
It's everything. It's governance that's built for growth. It gives you that critical outside perspective, maybe on tech or ESG, but lets you keep executive control. And maybe just as important, it gives you a forum. It helps you build consensus with your partners and stops you from feeling that, that crushing weight of being completely alone on big strategic calls.
Okay, that makes sense. So let's use that as our starting point. To really understand the Brazilian context, we should probably set a baseline. What do the global benchmarks for a resilient board look like?
Globally, the structure is actually pretty consistent. You're typically looking at boards with about 9 to 11 members. That number has been stable for a long time.
And the big trend, what's the non-negotiable?
Independence. That's the defining standard today.
And what does that mean in practice? What are the numbers?
Well, in big markets like the US or the UK, we're talking about 85% of board members being independent.
85%?
Mm-hmm. These are professionals with no family ties, no prior executive role in the company. Their only job is impartial oversight.
And in terms of expertise, what are these global boards looking for?
Historically, it was all about finance and economics. That was the main focus. But now you're seeing this really clear strategic pivot towards technology and broader business skills.
And what about age?
It skews experienced. The average on S&P 500 boards is around 63. So globally, think 60 to 65.
Let's touch on something that's becoming a real point of contention, especially with investors, this dual role problem.
Yes. The CEO, who is also the chairman of the board.
Exactly. Why is that being challenged so much?
It's a simple critique, really. It weakens accountability if the person running the company is also in charge of supervising their own work.
You've got a built-in conflict of interest.
A fundamental one. And you're seeing mature governance markets actively trying to separate those two roles.
And before we jump into the Brazilian data, just one last global point on diversity. Feels like we talk about it a lot, but the progress is slow.
Painfully slow. Even with quotas in more than 10 European countries, progress is a real uphill battle.
What's the global number for women on boards?
Only about 23% of seats. And at the current rate, the projections say we won't hit parity 50-50 until around 2038.
2038. That's a long way off. So that's the global picture. A slow push for independence and diversity. Let's see how Brazil stacks up. We're looking at this survey of 133 counselors. What's the immediate takeaway?
The immediate takeaway is that the profile is very traditional. It's a heavily masculinized environment. 77.4% of the respondents are men.
And age.
It definitely favors experience. Over 80% are 51 or older. You've got 51.5% in that 51 to 60 bracket, and another 29.5% who are over 60.
And I imagine the skill set reflects that traditional view too, right?
Absolutely. It's all about financial viability. 36% of counselors come from finance and economics, another 17% from business and marketing. Technology is there, it's growing, but it's still much smaller, around 12.8%.
You know, there's a number in here that really jumped out at me. The representation from human resources, it's just 3%.
Yes.
Doesn't that feel like a huge strategic blind spot? It suggests boards see people as an operational cost, not a core strategic asset.
It raises a really profound question about priorities, doesn't it? In an economy where talent is everything, having only 3% of your board's expertise focused on people strategy,
Right.
it seems risky. It's also interesting that in the sample, all of that 3% was represented by women.
So we have this very traditional profile.
Yeah.
But has the market forced any kind of change recently? A changing of the guard, so to speak.
It has, actually. There's been a really significant wave of renewal. About 35% of the counselors we surveyed entered the board market after 2020.
And that's not just random turnover.
No, it's targeted. It reflects this huge demand for new skills, for digital transformation, for innovation, and especially for ESG practices.
Can you just quickly define ESG for our listeners?
Sure. It stands for environmental, social, and governance. It's really a framework for measuring how sustainably and ethically a company is operating. So boards are realizing they don't just need finance experts anymore. They need people who understand climate risk, social impact, and good governance.
Did this post-2020 wave help with diversity at all?
It did. It's a small win, but it's there. While men still dominate, female participation did increase quite a bit after 2020. The entry rate for women grew by over 44% compared to the decade before.
So, progress. But from a low base.
Exactly. The shift is happening, but there is a long way to go.
And we also have to talk about geography. If you're a founder outside of the big economic centers, is it tougher to build a great board?
Without a doubt. The activity is highly concentrated. You've got about 65% of board activity in the Southeast and 53% in the South. So if you're elsewhere, you might face higher costs or just have a harder time finding that top-tier independent expertise you really need.
Okay, let's shift to structure and how these boards actually function. For a business owner listening, how does company size or revenue change the kind of board you should have?
This is a really key tactical point. For smaller companies, say up to 50 million RIAs in revenue, the consultative board is the clear winner. About 71% use this model.
Perfect for getting that outside strategy without giving up day-to-day control.
Precisely. But once your company grows, once you hit that 500 million to 2 billion RIAs bracket, the game changes.
And what happens then?
You see a major shift to the administrative board. About 66% of firms at that size adopt it. It's a signal that you're moving to a more formalized, high accountability structure.
So knowing those revenue triggers is key for planning your own governance journey.
It is.
And these boards, they seem to be meeting quite a lot. The engagement is high.
Very high. Almost half meet 9 to 12 times a year, and nearly a third meet even more than that. So basically, monthly meetings are the norm. The hybrid format is the most popular at 48%, but a lot of them, over 40%, are still fully in person for those high-stakes strategic talks.
Let's get to the money, compensation. What does it cost to bring this expertise on board?
The vast majority, nearly 79%, are paid between 15 and 30,000 reais per month. So that's roughly 180 to 360,000 reais a year. A serious investment.
It is. And the way that pay is structured, it tells a really interesting story about the culture, doesn't it? It's almost all fixed pay.
Yes, 75% is fixed. But here's the most telling part. Over 70% of a counselor's pay is not linked to company performance.
Now, that sounds totally counterintuitive to a founder. Why would you make that huge investment and not tie it to results? Isn't that a missed opportunity to align incentives?
It's a deliberate choice. It's a trade-off. The culture prioritizes independence above all else. The thinking is, if you tie pay to short-term results, like quarterly profit, you might incentivize decisions that are good for now, but bad for the long term.
I see. So the fixed pay is meant to guarantee impartiality.
It's to ensure they're focused on sustainable, long-term health, not just hitting a short-term target. You're paying for their wisdom, not for a quick win.
All right, we've covered what's working. Now we have to look at the cracks, the things that really threaten that perenniety. And the accountability gap seems, well, huge.
It's the biggest structural weakness by far. Nearly 40%, 39.8% of Brazilian boards use no formal evaluation at all.
Let that sink in. You're spending hundreds of thousands of reais on this strategic asset, and 4 out of 10 companies have no formal way to even know if it's working.
And if you put that next to the global standard, where 98% of S&P 500 companies do formal annual reviews, the difference is just staggering.
And even for the ones that do evaluations in Brazil.
It's mostly self-assessment, which again suggests that real, objective, external evaluation is still very rare, and that directly undermines the quality of decision-making over time.
So if that's the big weakness, what are the big worries? What's on the agenda for these counselors?
It's what I'd call a strategic triple threat. They're all clustered right around 57% of responses, so they are clearly top of mind. Number 1, risk management. Number 2, succession and leadership. And number 3, digital transformation and innovation.
The battlegrounds for the future.
Exactly.
So if the challenges are so clear, what's stopping boards from changing faster to meet them? What's the biggest roadblock?
It's not external pressure. The biggest barrier is internal inertia. 38% say the main problem is resistance to change from shareholders and managers themselves.
So the resistance is coming from inside the house.
It is. And that's combined with a lack of clear ways to replace underperforming counselors. So agility is being blocked from within.
Let's circle back to ESG for a moment. It seems like there's a lot of optimism there, a feeling of progress.
There is. You have nearly 75% of counselors who believe boards will be more prepared for ESG challenges in 2025 than they were in 2020. So a strong sense of improvement.
But when you dig into that number, you find a really interesting split, a kind of generational conflict in perception.
That's right. The data shows a statistically significant link to age. The younger counselors, those under 40, are much more skeptical. Half of them either see no real change in ESG preparedness or think boards are actually less prepared now.
That's fascinating. So the veterans see progress, but the next generation sees stagnation.
Exactly. The younger group has a much higher bar for what real change looks like, whereas the older counselors, say 51 to 60, they see a gradual positive evolution. They see the progress, but they also understand how long these kinds of deep structural changes take.
And one final point on diversity. Even with the recent growth in female participation, you mentioned their influence is still somewhat limited.
It is. The growth is happening more in the consultative boards, which have less decision-making power. So while presence is increasing, true inclusion women in positions of high institutional power on administrative boards, that still needs a much deeper change in how people are nominated and chosen.
So let's tie this all together. What does this mean for you, the founder or CEO, who's trying to build a lasting company? It seems like Brazilian governance is in this fascinating dynamic transition. It's modernizing, it's bringing in tech and ESG expertise, but
that momentum is being held back. It's hitting friction from two big internal problems. This massive accountability gap from a lack of evaluation and a culture that resists change and sticks to traditional profiles.
which brings us right back to the central theme of Perennidae.
It does. And here's the final provocative thought for you. The data is crystal clear. The biggest thing stopping your board from becoming more agile and effective is the leadership itself. It's the shareholders and managers. So the question you have to ask yourself is this: how long can you afford to prioritize tradition and comfort over the very things like formal evaluation and true independence that are the proven guarantees of long-term survival?
A structural decision that will absolutely define your company's future. We really encourage you to find the full Board Trends Brazil document from the Evermonte Institute to get the complete picture. Thanks for joining us, and we'll see you on the next Deep Dive.